Hi, everyone, and welcome back to another show. My name is Tyler, and I'm with Matt, the founder of ORATS. ORATS is an options analytics platform built on top of over 15 years of historical options data. And our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Last week on the show, we focused on the time and sales tab, where we looked at some of the largest trades and did a short call spread on Bath and Body Works. We'll also look at how our wheel strategy is doing, which we started 2 weeks ago. The topic for this week is finding trades using skew and term structure. So we'll take a look at some of our most popular options indicators like skew and slope, and then use them to identify opportunities in the market and find a trade. Matt, if you're ready, do you want to share your screen and go over the trade from last week?
Sure. All right, so I took a screenshot of our YouTube because we closed this out. It was a short call spread that we found from our largest trades, and then I had a pretty tight profit and loss because I don't usually do those types of trades. So we got out for a small loss. I think it was 15 cents or something like that. And then we also are continuing our SPY wheel trade, selling the 50 delta puts. And then if we get exercise, we're going to sell a in the money call, but we haven't had to do that yet. So short-term puts that we're selling have been good. So this one that we had on was December 6th. It's now December 11th. So we made the 280 on that. And then if I go to my positions, paper trading, we have the 13th on right now, and it's already has a good profit at $250. So the other one was 280, and this was so over $500 on the trades, and then we had some before that had done pretty well. But today we are talking about what, Tyler?
Finding trades using skew and term structure.
All right. So let's talk about what that means, first of all. Time structure is the at-the-money volatilities as you go out in time. So here's a graph. I'm going to try to zoom in here. So here's a graph of expirations and how that term structure looks. As you can tell, there's a lot of high term structure, short-term implied volatilities here around 15 in the market, and then it kind of bottoms out as you get out in January. We have a lot of news. This is a big news week in the markets, and then it's going to die down pretty good. So that's why that skew looks kind of odd. And the other thing that we're going to be talking about is skew, or we call it slope, or we call it slope because we take the slope of a tangent line at the 50 delta. So this is implied volatility at each strike for each month. And it kind of looks like a smirk, I'd say, or a snake. And so we measure that slope, and we say what it is. And so we present it here as slope. And you can see that it's, right around, this is under 1%. And then as I go out, so this is SPX, as I go out, it starts to steepen up. And I'm just clicking and going out. Now I'm in January. And, we've already got the slope up to 4.7%. So this steepness, what it generally means is the steeper it gets, the higher the low strikes are. So that typically means the puts. And then the call versus the calls that are more out of the money. And so what we see, and this is, for the longest time, we've been tracking this since 2007, it was a lot steeper. It got up to almost 9%, if you could believe that. And really the way to think about that is every 10 deltas, that implied volatility is 9%, or in this case, 4.7% greater than the higher strike, 10 deltas higher strike. And so if you had 100 volatility, the 10 delta deeper, higher call delta would be 104.7. So that's what the slope means. And so the puts, are generally higher than the calls. So we make that a positive number. And now kind of there's a economic reason or a market reason that it's shallower these days than it used to be. And I believe, I haven't heard this else, but I believe it's because of the high popularity and high liquidity and high volume of the zero DTE trades that go on. So what that allows market makers to do is be able to shift their positions that they have on, so they don't have to demand higher implied volatilities for the low strikes, those puts, because they're able to trade out of their kind of systematic positions that they used to put on, where banks and where everyone was buying the puts and selling the out of the money calls, generally doing like buy rights to sell calls and then owning puts to protect their position. So what I'd like to do today is to it's especially shallow today. So what I'd like to do is find a trade based on skew. And the way I'd like to do that is to go to the stock scanner. Does that sound all right, Tyler?
Yeah, that sounds good. You can also look at the history of slope for an individual stock in the trade builder and adding that graph underneath. If you wanted to start there. So
yeah, so if we add that graph, you could see that it's come down quite a bit, and it was a lot higher, 8% not too long ago. It tends to, like when the market's rallying, it tends to get steeper. And then as the market kind of goes down, it gets flatter. So let's find a trade that benefits from skew. And one of the things that I was thinking was if you do a vertical spread where you're buying a lower strike and selling a higher strike. And so what that tells me is the more popular trade is a short put spread. So you in a short put spread, you buy a put, and then farther out of the money, which is a lower strike, you would buy a put. So you sell and buy. So let's look at, and then I was thinking that if you go to the back tester, you look at its short put spread, and then you look at, and we'll kind of say none to these. We'll just kind of get it down to the bare bones of the strategies. We'll kind of set this minimum and maximum of like 20 to 100 days. And then we'll also set a minimum of 0.1 to 0.45 or something. So these are typical, more typical put spreads. Let's see, entry triggers. And then if we then look at the entry triggers, so we'll say, so I have none selected for everything else. So I merely just want to look at what are the best strategies for put spreads. And then I've taken a picture of that. So let's see if we could get this. So when the slope percentage is low, those are the best performing strategies. You can see a couple highs here, 55.10, but that 55.10, it performs better when it's in a low slope environment. So what this is saying is, yeah, and it's somewhat logical, is when slope is really this low, a short put spread is a decent trade. So the next step that we'll do is go to the actually go to the stock scanner, because I want to find ETFs that have a shallower skew.
yeah, we call it a cheap put call skew scan, which is we have it in our templates.
A template, yeah, right. So put call skew rich, put call skew. Thanks, Tyler. Yeah. So put call skew cheap, has a various.
Well, yeah, let's go over those indicators a little bit. So, you clicked on the cheap put call skew scan, and that's bringing up all these indicators that we've already curated for you, so you can see we're comparing the slope to the 5-day average, to the 20-day average. We're looking at the slope percentile over the last year, our forecasts of slope versus the current slope. And so we're setting all these values, to min and maxes so that we can narrow down, over 5,000 stocks to ones that meet these criteria. And I think what you're going to do here, Matt, is, change the asset type to just ETFs, right? And then only find ETFs, right?
I was going to, but I could already see IWM's slopes, but I'll do that just for posterity. So I could say only stocks. So we have assets, you could probably mouse over, broken out into various types of assets. So the ETFs are numbers 5 to 8. So if you sort it that way, then yeah, you get IWM has a very low slope. So that's one I'm going to concentrate on for our trade that we put on for the trade that we put on for the what do we call this? What are we calling this? I was going to say the trading club, but it's not really the trading club.
Our live shows or our live webinars with Tradier.
Right. We need a catchier name for that. Anyway, so here's our outlook page. We look at implied volatility versus similar, contango, which we'll talk about later. But here's slope versus similar. So basically, we're looking at the IWM slope versus its component. So, and we have some other things down here as well versus its forecasts and versus its moving average. But as you can see, it's very low. And we don't normally say very bullish, but we've said very bullish here because everything is saying that this is extremely low slope in IWM. So now in order to find the actual options that meet that criteria, I'm going to go over to our option scanner. I'll clear out all my settings. I'll add IWM here into the symbols. And then for the strategies, I'm going to find a short put spread, which is there. I'm going to go down to 2 weeks to get the 10, and I'm going to widen the days so I'll just open it up for anything.
So Matt, you're adding a short put spread here. Can you go over why, specifically, that strategy is good for a cheap slope?
Yeah. So as I talked about before, the put that you're selling is a higher strike. So that's and then versus the put that you were buying, it's a lower strike, and that's what you want to do when you have a slope that is shallow, that is expecting the out of the money puts to come up in value. Does that make sense? Does that have enough information in it?
That makes sense. You could also do this with a short risk reversal or a caller strategy. But you're not doing that.
Right. A risk reversal is buying the put and selling a call. So that's an extreme measure. The problem with that is that you have then a lot of delta risk, whereas in a short put spread, we don't have as much deltas, because when you're buying a put, you have negative deltas. When you're selling a call, you have more negative deltas. And so you add those both together, you have a very negative delta trade. If you were to just do a put spread, then you have positive deltas by selling a put and then negative deltas of buying a put. It is slightly positive, but not nearly as delta sensitive as the risk reversal.
Gotcha.
That makes sense.
Yeah, that does. So what you're doing here is you're optimizing the shallow slope, but at the same time not, putting yourself at that much risk with the stock price.
Right.
Okay.
And so now the way that we work in the option scanner is we could sort on a lot of things, but the best sort in order to find the best overvalued or undervalued skew trades is to look at our forecast, because we make a forecast of skew and we put that into our surface construction. So what that means is we put a theoretical value, forecasted theoretical value on all the options, and within that we use the slope forecast. So the slope forecast, as we saw on the outlook page, was for a higher slope. So that's why we're entering this trade. So the best way to find the best one is to use that F percentage. And you can see the F percentage is pretty high. and the highest one is for the 20th of December, selling the 183 with the stock at 187 and buying the 178 put. Just a couple more bits of information in here, for this trade. There's a risk reward, there's probability of profit, but let's go ahead and take a look at this trade. It's a relatively tight market, 10 days to expiration. Is that going to be enough time? We don't know, but let's just say it is because there's a lot going on in the market. Hopefully we'll get steeper. So risk reward of 1 to 5 is a little bit steep, a little bit much, but I think we'll go for it with this trade. So this is the trade that we're going to do in our trading account for this particular. Actually, let's just go ahead and pay or sell it at the bid. Okay. Here with our order, but let's we'll figure that out later. I wonder if I have enough money in here for it. So paper trading, yeah. So there it is. So we actually filled on that and on that short put spread, and we're down $2 because we paid through the mid price, but we'll continue to track that. So anything else on the skew before we move on to term structure, Tyler?
Yeah, that was pretty good. Good trade that we found. I mean, it's pretty cool that we can look at over 5,000 stocks, narrow them down to a cheap slope, and then from there narrow it down to the best option, based on our theoretical values. I mean, we're looking at so much information and drilling down very quickly. And so, we can do the same thing with Contango. And I think, if we go back to the Outlook page, we can see that graph right above slope kind of shows you the term structure versus our Contango measurement. It's pretty interesting to look at.
Yeah. Why don't we do this, though? Why don't we go find, just like we found IWM, because IWM has a certain Contango. So there's right now in the market, they're very steep contango. So I want to be, I shouldn't say it that way. The contango is actually going down. So let's explain the definition of contango. Contango is how much the front months are below the back months. The opposite of contango is another word that you don't need to remember. You won't be tested on this, called backwardation. So it's mostly the market is in contango, meaning the front months are below the back months. But with, like I said, there's a lot going on in the market. Whenever there's a lot going on, now this is an ETF, or if there's an earnings, then the term structure gets into backwardation, where the front months are above the back months. So what we're going to be looking for is a stock or an ETF with a high front month, low back months. So that's in backwardation, but we just look at it in terms of contango. So negative contango is what we're going to be looking for. So we're going to go back to the stock scanner, our friend, the stock scanner. Going to clear the settings out, and we're going to build a scan that looks for ETFs that have large contango. So here's contango in the skew category. So we want negative contango, so we want low. So let's go bottom 50%, and we want let's see, we want a stock price. I like them over $50 for ETFs that we're going to be finding. Volume, so I want option volume for at least over 2,000 contracts. Again, I want to look for a asset type of ETFs like we looked at before. Maybe some high market cap in there wouldn't hurt. And let's see what's coming out here. Then let's sort it by contango. We're sorting it by negative. We're sorting by ascending contango. So we're seeing some 3x things. Look at we got. So I don't like to trade those, but look at we got IWM again. You're right, Tyler.
Can you scroll down a little bit, Matt? Our faces are covering me.
Oh, yeah, sorry, I can't
Yeah,
see our face.
that one. Yeah, exactly.
So, like I said, I don't like to trade these 3x types, but there's IWM again. So, dare we put on another trade in IWM today?
Another IWM trade. Yeah,
Should we do another one? You want to go for it? Okay.
I think we should.
Now let's do it. Yeah. Okay. So let's do a calendar now. And yeah, so let's just do it at the money calendar. So let's look at, again, let's just review. Let's go to the Outlook page, because the Outlook page has that contango graph. So yeah, we also saw a very low contango here and this term structure. So now we're going to do the same method, because you want to use forecasts in order to find. So let's clear all these settings. I won't get ahead of myself, but IWM. So we're going to do a long. We'll do a call calendar spread, neutral spread, and that's a little long term. Let's do a shorter term and maybe extend our longs longer, maybe just 60 days, and something. Maybe we'll do 30 days max on that. So then we'll widen that out just a tad. So we want to see. We want to sort by forecast again. So let's do our weightings. So let's bump up forecast. Risk reward. We'll take that out of it and take a look at what we have. So now this goes, again, like you said, we've gone through all stocks and found IWM is the best ETF. We've gone through all of IWM's relationships that are defined in these deltas and days to expiration above, and ranking these by the forecast. So yeah, I'll put this up again. So the highest one is now selling that DEES. That's where our put spread is. So actually that would be kind of good, because we're long that month, Vega. So this will flatten us out a little bit. It's almost like we tried to do that, Tyler.
Nice.
So yeah, so we'll be selling a call in DEES, buying a longer term call in January. So this is the 186 strike for $1.09. Our SMB, that smoothing number, that kind of orange line that we draw through. So that's kind of how you look for fair value, not always mid price, because this is a little bit wider of a market. So do it that way. I neglected to add alerts. Maybe I'll go back and add alerts on the other trade. So below, actually, you don't want to. I don't like to get out of these, but I just want to be notified. On these calendars tend to be lower price, so you don't want to get out at a certain percentage. So I'm going to put Tradier Hub.
Yeah, so these exit alerts, they're not automatically exiting the position. You're just getting a notification to your email, to your phone, when these things happen.
Right. So I just want to see how this is going. Something that we added was, we don't want to be alerted if the market just widens out for whatever reason and makes the midpoint here or there. So we set, based on how wide the market is now, a little bit wider than that, and then we'll be notified. So don't bother me if it's too wide, but if it's this or below, then you can then notify me. So let's our paper trading does give you a higher chance. You'll get filled almost for sure at $1.14 if you trade, but it's always subject to chance. We put a little bit of randomness in our paper trading front end. So let's see how that goes. So yeah, we're still working. We did get filled there. So we get filled on the calendar. And so these are the two other trades that we'll be tracking for next week. So stay tuned and see how we do. I think these would be good trades. I like how we're long some long some Vega and short some Vega in these two strategies in D. So looks like a good. I like these two trades, Tyler.
Yeah, these are good. One thing I wanted to mention also, we're looking at ETFs, so earnings isn't going to matter, but we do have an X earnings implied volatility calculation, and that matters a little bit when we're looking at the term structure. Matt, in the Outlook tab, you can toggle on and off that term structure
All right.
if you're looking at X earnings. So maybe you can explain a little bit how we calculate X earnings and the importance of that, comparing. I mean, it allows us to compare stuff across time and across related equities, because we're taking out the earnings effect, from stocks that report earnings and then against ETFs and stuff like that.
Yeah. So what do you want to look at? Oracle, Costco, or Adobe?
Let's look at Adobe.
All right. So Adobe 6. So first of all, let's go to the trade builder and kind of get into what Tyler was talking about. So Adobe's coming out in 2 days. So that's why these vols are jacked up here. So, the volatility, in 30 days is about 35. Now, if we were to go check out the outlook for this, where we use the X earnings, you could see in the mouse over, hopefully, that the implied volatility is 26. So that's one thing Tyler was talking about. The other thing was this. So this is the term structure, and this is the expiration skew. So you could see the term structure going. I think what you're saying is you could click this off
right there,
and then that kind of mellows everything down to about a 26 from a 70, almost 50. So that's a little crazy. I think that's that's what you're talking about, Tyler. Like, we have ways to take the additional amount of earnings out of a stock. So then you could track things like what is the true contango, and there is some backwardation here, slightly negative, I'm guessing. Yeah, slightly negative. So yeah, that's a good point, Tyler. You could look at.
It's a very important thing that we do, because otherwise, our indicators are going to be skewed towards, whenever earnings happen, right?
So what Tyler's saying is, if I go to the trade builder, and I think we have a graph really well here. So, if in the trade builder, you'll see, these vertical lines are earnings. So the volatility comes up and crashes down, comes up, crashes down, comes up, crashes down. So that's going to really skew your results when you're looking at, in the Outlook page. What we look at in the Outlook page is what is the true volatility, not just the earnings move, but what is the kind of underlying volatility that will, that we want to look at for more predictive measures. And so that's why we use X earnings. So yeah, thanks for that point, Tyler. So that's all I have on that term structure and also skew. So very important topics that we covered today, Tyler.
Yeah, that's great. Thanks, Matt. Yes, we reviewed slope and term structure, and then we used them in the stock scanner and the option scanner to help us find some good trades. And yeah, we have a lot of proprietary indicators that we calculate. We touched on X earnings indicators, and there's a lot more to see with that. So we'll probably cover more of those indicators in some coming episodes. But yeah, I think that's it for this week. If you have any questions about our tools, you can email us at support@orats.com and or read more on our website, orats.com. So thank you, Tradier, for hosting us, and we'll see you again next week.